we're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks which are buzzing in trade. I am Agam Vakil. Let's welcome in our experts then. We have Sangeet Lakkar of Newberry Capitals, independent advisor Vivek Mavani, and independent expert Shahina Mukadam joining us on the show. Thank you guys for joining us here. And today on Hot Money, we will discuss TCS, United Spirits, Vigar Industries, and Phoenix Mills. And let's get on to the headline of the day for that matter. And we have the first stock, which will be TCS. Now, we all know, and we have discussed this enough, that TCS is the first Indian company to cross that, $100 billion mark right now. But, you know, if you can consider the Bloomberg consensus, about 33% of the analysts for now are buy, and all the others are either hold or sell. So there is a little bit of conundrum with respect to what you can do with TCS. So the question we are asking is there a limited upside for TCS right now? And I know this is a very tough one to answer considering the fact that we've seen TCS move up. So I'm going to open this discussion to our experts. And Vivek, I'm going to start off with you. What's your call here?
Well, I'm going to reiterate the call we have discussed TCS on the earlier programs also on your channel. I continue to remain positive. It's a buy on decline story. Yes, the stock has moved up sharply in the last few months. I mean, it's been almost 20% move in the last, I think, about 2 months. Continue to be positive, and every declining is a buying opportunity. So that's my sense. Strong growth coming back. I mean, the reasons being that strong growth in their digital business and growth coming back in otherwise a laggard market like Europe and UK. So even Europe and UK are back with a high single-digit growth, number one. Digital, there seems a serious acceleration in terms of growth rates, with just Q4 growing at like 43%. I mean, the 9 months itself was at 25% growth. So in terms of the company evolving from traditional IT services to new generation stuff, including artificial intelligence and what the exotic stuff that everybody talks about, where the Indian companies can migrate there, TCS seems to be showing the way that yes, they can.
Right.
Valuation wise, yes, at about 24 times current year, that is the financial year 18-19 earnings, maybe at about 20 times 20. Doesn't seem very expensive. Yes, the valuations have moved up, premium to other IT players, but still a serious opportunity in terms of investment.
All right, fair enough. So that's the view there. Shahina, what about you? How are you looking at this one?
I personally hold TCS for a long time, and I would continue to hold it. It is, yes, one of the most expensive stocks in the large cap IT portfolio. But if you compare it with the overall market, I still think it is attractively valued. Secondly, I think the fourth quarter numbers were very attractive. A 3.9% growth was much higher than on a QoQ basis, was much higher than was expected. And I think across all spaces, they have shown a growth, especially digital, as was already touched upon. I think that digital contributes now almost 24% of their revenues. And with a strong growth in digital and with a good strategy for growth in that segment, US market picking up, the rupee dollar moving in favor of the overall IT segment, I think it's a space to continue holding.
Sangeet, how about you? What's your initial take?
So I'm neutral to the stock. I think majority of the points are covered by the guest. Just to add in, it's a solid business, it's a solid company. Obviously, quality comes at a price. And you'll also have a lot of tailwinds from the currency now coming in the coming year, which has been, a headwind for all the IT companies over the last couple of years. However, on a relative basis, I like Infosys better than TCS because currently the street is quite crowded in favor of TCS as compared to Infosys. However, any positive surprises coming from Infosys end as far as beating their numbers, beating their guidance would be taken very positively as compared to future numbers by TCS.
All right. Shahina, you said you are relatively positive. You continue to hold TCS, but in comparison to other companies, you really think that TCS has a better better prospects with respect to growth in say comparison to other peers like HCL Technologies, which has always guided for better growth?
Well, the TCS management also sounded pretty optimistic this quarter, post numbers. But having said that, I do think that Infosys and HCL have equal, if not more, potential for showing better numbers.
Right.
So if one was to take a pick in terms of the pick as of now, I think Infosys would be ahead of TCS if one was to be buying because of valuation. But in terms of potential and opportunity, I think TCS has been there, for all these years. They have their phases when one does better than the other in terms of stock performance.
Right.
So in terms of valuation, yes, I think Infosys would be a better bet. If you're already holding TCS from a number of years, you have outperformed any which ways.
All right, Vivek, you did say you are neutral right now, but the question I want to pose with respect to TCS is that the management, as per indications, is doing a lot to change its business, and the commentary coming in from TCS has been much better than something like an Infosys or Wipro. HCL Technologies is a slightly different ballgame. The question is that, do you not think that the prospects that TCS offers right now, based on that, we could actually see growth much better than some of its peers, thereby that's the reason why the markets are giving the valuations that it is enjoying right now?
Of course, I'll absolutely agree with you that in terms of TCS, although being the largest company, would still have the highest growth rate on a relative basis compared to an Infosys, Wipro or an HCL Tech in percentage terms, and even an absolute growth in terms of revenues and profits. I absolutely agree with you. I'm positive on it, and I would say every declining is a buying opportunity. One does not necessarily chase every stock on its way up simply because of the positive sentiment. I mean, today the sentiment is positive in favor of, and just the TCS numbers on Thursday evening. So Friday, if we notice, all IT stocks basically had an up move, and it seemed very strange that Infosys post its own results had fallen 4% the next day.
Right.
And on Infosys positive commentary, TCS positive commentary on the Thursday evening, Infosys was up 4% on TCS results.
Right.
I mean, it seemed absurd from that point of view.
Right.
I'll agree with Sangeet. Yes, Infosys on a relative basis offers better value because probably we'll see acceleration in growth in Infosys as well. Valuations today at discount. In a probably normal case scenario, both should be trading at similar multiples. So Infosys has some catch up to do, which if they display positive growth and commentary in the next few quarters, I think Infosys can catch up pretty much maybe in a quarter or two. But having said that, TCS on a standalone basis still offers a terrific long-term opportunity. I would use, rather than chase in a sharp rally, I would wait for some correction or some pullback to be entering the stock.
Okay, fair enough. Before I conclude this topic, I just want to take this with Sangeet. Sangeet, you mentioned about the Infosys offering better value, but the truth is that there's a new management which has come in. They're still finding their feet. There's going to be a lot of changes with respect to strategy. Do you not think that growth just may take a backseat while these guys go in and consolidate their plans for Infosys right now?
So the last quarter results which the Infosys came out with, now the guidance that they have given for the next year is 22 to 24%, which is lower than the street estimates. Primarily, the reason for the lower margin estimates were significant investments in the growth opportunities that they are forcing.
Right. Yes.
So if the management themselves are forcing enormous growth for which they are ready to forego the current profits, I don't see that should be a concern as well. My main thesis is if the street has written off a particular story, and TCS being a very crowded trade at the moment at the current valuation, the risk to reward ratio in case of Infosys is in favor of the investors as compared to a TCS.
Right, fair enough. There you have it, guys. Well, that's the view on TCS coming in. Well, largely neutral, too positive. But we'll move on to the second stock on our radar, and it's United Spirits. Let's ask our experts if it is the best way to play the liquor consumption theme. And we've all seen that substantial up move in a lot of these liquor stocks. But the mainstay and perhaps the largest player by a mile is United Spirits in this particular area. So I'm going to pull it open. And Sangeet, I'm going to come back to you on this one. What's your view here?
I'm very bullish on the sector and on United Spirits per se. So you have seen the entire liquor industry going through a considerable headwind over the last couple of years. May it be the state level bans from couple of states, also the Supreme Court ban. So now I think the worst looks to be over if you see the last couple of results also. To add to it, you have the molasses prices because of the sugar glut that we are witnessing this year.
Yes.
To be at least about 30 to 40% lower. The results of which will be shown in the current quarter. It's a great company, I think enormous opportunity. I'm pretty bullish on the company.
Okay, Shahina?
Well, I think it should be part of your long-term portfolio. The main reason being that it is very expensive.
Right.
I mean, you're really buying into a stock where your EV by EBITDA is like, phenomenally high. Even your P is around maybe close to 100. Yes, I would factor in the very poor first half. So hopefully next 2 years the valuation will start looking better.
Right.
So I would hold it in my portfolio. If one was to buy it, I would be buying it at dip. So basically, I have a sort of neutral call for current purchase.
Right.
But yes, I would look at it at declines. The main reason being that they have got very strong brands.
Right.
I think across the segments in their Scotch, whiskey, I think their luxury brands, volumes, I would expect to do much better. Despite revenue remaining flattish types in the last 2-3 years, we've seen volumes looking up.
Right.
And they have had issues in terms of the highway ban that he touched upon. Supreme Court has sort of come out and given some sort of set off to them. You also have had states like Bihar, like large states where they've had to take this hit.
Right.
So and they've got huge debt. So they've got a lot of write-offs that they have done in the last 2-3 years, which actually has affected the overall balance sheet. So I think balance sheet quality is also a lot to be desired in terms of the huge debt versus the net worth.
Right.
But I would look at it because of the brands and the huge domestic opportunity and buy it at dips, holding it for a longer term.
Okay, fair enough. Vivek, how about you?
Well, I will definitely not buy it. I mean, in the sense valuations are just a deterrent. I mean, simple as that. I mean, Shahina touched upon valuations at 100+ times current year earnings. Even if one were to assume a very aggressive growth over the next 2-3 years, that profits will double and all that, I mean, you still have a stock which is going to be like, which trades at something like 50-60 times earnings on a 2-year forward basis, which to me is not just aggressive, it is just over expensive. I mean, all positives I'll take into consideration in terms of very strong brands, presence across all segments, right from the most economy to the most premium. But notwithstanding the distribution network, notwithstanding all its strength, the franchise value, everything, they had a decline of 10% in volume terms over the 9-month period. And even fourth quarter, if one were to go by the industry estimates, there would still be probably some decline in volumes, low single-digit volumes. So now any consumption story having volumes declining is not really a growth story, because regulatory issues, state government issues.
I'm sorry, your time for your initial thoughts is up, but because I was going to go to you as well on the valuations, you can just tell me a little more about. You can continue.
Yeah. So basically, the headwinds that they had over the last 2 years is not that the headwinds are going away. It's not that the headwinds are turning into tailwinds by any miracle. Next 12 to 18 months are going to be the periods of election, and this invariably for state elections is an issue. Whether the ban is actually imposed or not, just the talk of it by some parties is enough to dampen the sentiments for the sector as a whole. That's number one. Number two, as I said, any growth stock needs to exhibit volume growth, and United Spirits over the last 2 years has been faltering on volume growth, and there has been a decline in volumes. The revenue growth and profit growth has still come about because of better product mix in terms of premiumization. Hence, for the same volumes, I mean, the revenues have been higher, and price increases that they have taken from time to time. But a business model can't be based only on superior revenue mix every quarter or every year and taking aggressive price increases. I mean, this is not an ITC. I mean, at the end of the day, ITC can get away doing that for 20 years. I doubt if United Spirits can get away doing that for a very long time.
Right.
So the valuations definitely don't support it. To come back to your opening question, is this the best way to play the liquor story? Well, my counter question is, if you have to play the consumption story, is liquor the only way? There are a whole lot of other things that one can play the consumption story with.
All right, cool. So that's the way our experts are viewing, at United Spirits. Well, we're getting mixed views here, but the question on valuations remain, and also the questions on growth prospects. And with that, we move on to the third stock. That's V-Guard Industries. And is the stock overvalued after the recent up move? Guys, we have a minute for your initial thoughts. So Shahina, I'm going to start off with you.
Yes, it is expensive. Definitely, in valuation terms, it's pretty expensive. Here again, the whole issue is that they have got two segments. Now, if you're looking at the consumer durable segment, which is about 65% of their revenue, there I think there is a lot of opportunity. The growth has been there, but I think there is still, with increased spending power that is coming into the hands of people over the next 1 to 2 years because of policy, government policy. I think there will benefit growth in their segments which they've already well established. The newer segments which they've had in electronics, electrical systems, there I think which is also growing reasonably well, 18-19%. I think the opportunity exists. They have created strong brands. So I would here again have a neutral view, but buy it at discount, buy it at slight dips because of valuation. But I think it's got a very strong hold on both the spaces where it's got major market share.
All right, so neutral view coming in there. Sangeet, a minute for your initial comments here.
So I'm pretty optimistic about the company. Obviously, valuation looks little stretched at 50 times. It's one of the most expensive stock in this space. However, if you see, so last couple of years, the company has moved from a primary south-based market to a pan-India player.
Right.
And just over a couple of years, if you see the revenue contribution from non-south states is close to 35% of the total revenue now.
Okay.
So the non-south markets for them is growing at close to about 35%. So that's a pretty strong execution capability, I would say so. It's a debt-free company. Valuations looks expensive, but yes, the opportunity is enormous. So maybe at some dips, it's a good portfolio buy.
All right. So that's the view coming in from Sangeet and Vivek. How are you viewing this one?
Well, valuations have moved up recently, but any dip is an opportunity to accumulate for long-term portfolio holding. So, I mean, from about 240, 245 levels now, I mean, if it were to come closer to 200 or less than 200 in any correction over the next few months, I think is an opportunity to buy. So, I mean, I do buy the fundamental story. It's just the valuations seem a concern. If the price corrects, the valuation also gives that comfort. So basically, the thesis is not, I mean, my colleagues have just mentioned, I mean, very few companies, if we look at historically the last 20-25 years, from strong regional players have become pan-India players. V-Guard is one of them. So from primarily south-based, especially Kerala, over the last 5 years, I mean, what was 5 years ago, today they're a pan-India player with 35% of non-South India sales. That's one key positive. Second thing is, from a single product companies, very few companies migrate or make the transition to multi-products and brand them, expand the distribution network aggressively. Very few companies have been able to do that. V-Guard has been able to do that.
I don't mean to interrupt you, but I'll come back to you on your initial thoughts. The real question that I wanted to put in was, we know that your valuations are expensive for V-Guard. But the thing is that the fact that they still get the majority of their revenues from the consumption space, from the consumer business. Sangeet, if I can urge you a little more on this one, it shouldn't really matter at some point in time, because some would argue that because it's in the consumption space, you can't really put price to earnings multiples because we don't really know what kind of growth it will see. How would you respond to that? So,
I am obviously optimistic on the business and the stock. And if you see historical, the company has been a high growth company. Also, if you see in between, there were increases in the raw material price, especially the copper. But this company was very quick to pass it on to the customers. Right. So that also demonstrates the power of brand, the pricing power which it commands. So I obviously am very positive on this stock. obviously, valuation, I feel it's a little expensive as compared to the peers. If you compare it to the Havells or Crompton Consumer, then it's a little expensive. So that's why it's a good buy at buy on declines.
All right. So Vivek, you were making us a few positive points. Some of these positive points were mentioned by our other two experts. Any challenges right now, other than valuations on a fundamental basis, in terms of story, are there any challenges for V-Guard?
See, two challenges that I can, I mean, one is, as Sangeet mentioned, I mean, commodity prices. I mean, input for, I mean, a key input in whether all of the consumer durables, home appliances that V-Guard is into, copper and plastics is the key raw material. So for the external case is always a plastic or a plastic derivative, which is driven by the crude oil cycle, because they are crude oil derivatives, and copper, of course, interiors of it, copper is a large part of the cost. So both these cycles are on an uptrend, and one needs to see how well they can protect margins by passing on costs, or are there margin pressures in the interim. That's number one. Number two, an aggressive distribution network expansion also calls for very high spends on advertising and sales promotions, offering higher margins to dealers and distributors and so on and so forth, which also tends to dent margins at some point of time.
Right.
They also need to take aggressive branding campaigns, advertising campaigns, because practically every 6 months a new product is getting introduced. So obviously everybody needs to know about that. So ASP spends, advertising and sales promotion spends also will be higher.
Okay.
But at some point of time that has to taper off, because no company can to perpetuity keep spending on ASP and drive sales growth. At some point of time, that brand strength has to come to its fore, and we need to see margin expansion. Now, what is going to trigger those margin expansion at 10-11%? From what it is at 10-11%, because branded companies typically should be having better margins and better cash flows than what V-Guard has.
Right.
So those are the concerns. Valuations, of course, if they correct, I'm a buyer.
Fair enough. Okay. So there you have it, guys. That's the view coming in on V-Guard, and well, we'll move in and address the final stock on our list, and that's Phoenix Mills. Now let's find out if it's outperformed or remains and it's here to stay. Well, the truth is that we've recently had a lot of broking houses initiate coverage on this one, and well, they've of course all given it a buy, and it's an interesting space because considering it's also into realty, we'll have to wait and watch as to how it develops its business moving in. But let's also take stock of what our experts have to say. So coming back to you, Shahina, how are you viewing that? A minute for your initial thoughts.
Yeah, here again, I think today we've picked all expensive stocks, which definitely have great opportunity going forward. So invariably, again, this would be a stock I would be picking up at declines. If you see, here we are discussing the retail consumption space, and I think this is one stock which is actually entrenched in it. It's got, I think, about 7 malls across 6 cities. And we are aware of the Mumbai mall doing very well, and I think the South is equally expected to contribute to their revenues and profitability going forward. They are well entrenched in the retail segment also, where I think they've got big opportunity. I believe they've got something like 17.5 million square feet, and I think the government policy, you have REITs coming in. I think all these factors, plus you have RERA, which I think the organized players will have a better hold over the overall segment in real estate compared to the smaller unorganized segment. So I think it is across its spaces, both in retail as well as in real estate, where the move from unorganized to organized is a positive for a well-entrenched company. So I would be a buyer at declines.
All right, a buyer at declines. Sangeet, would you agree?
Yes, I agree with Shahina. I think it's a pretty unique company. Now what has happened is over a period of time, the company has moved its business model from a residential developer to a more commercial and a retail portfolio with mixed-use development. The company has about 6 million square feet of retail space. About 65% of the revenue comes from retail, and more than 90% of the income is actually coming from the lease rentals. So it's a pretty stable set of annuity income which the company enjoys. It currently makes about 400 crores of cash profits on a market cap of 10,000 crores. Valuation may be slightly expensive, but it's not a bad buy, I would say so.
All right, valuations may be slightly expensive, not a bad buy. Vivek, I know that you don't track this stock, but is there anything else in this particular sector that you may, like or prefer?
Well, actually, I've not really been a fan of real estate or real estate related stocks. So I'll reserve my comments. I mean, in the sense I'm not basically positive on the sector as a whole.
Okay.
Phoenix could be a different animal within the real estate space. But since I don't track it, I'll reserve my comments on Phoenix as well.
All right, fair enough. So then, Shahina, I'm going to come back to you. As you already mentioned that yes, there are valuations out there which may be an impediment in the near term, but it's a good company to go with right now. So in that case, what are the possible problems that this company may face, and will the unlisted space have anything to do with its growth, say in the next 2 or 3 years?
No, I think in fact it's a positive from the move from unorganized to organized.
Yes.
My concern here is the valuations. If you look at the EV, let us look at FY18, the year that has gone by, before we talk of growth, which is definitely going to be there. In terms of pure valuations, if I was to buy it at current levels, I'm buying FY18 EV by EBITDA at 42 times. I'm buying the P's around 43. Okay, so and if you look at it from book value, it's about 4 times price to book value. Even if you assume a growth of about 25 to 30%, it will take about a year or two before it starts looking attractive. So I would be buying it. I think there is opportunity, but I would be buying it at slight declines.
And Sangeet, do you see any challenges in this story right now?
So the biggest challenge for any real estate company, so to say, is the execution.
Right.
Obviously this company has demonstrated its impeccable execution in all the malls. They have a portfolio of about 7 malls. Recently they have commissioned one is the Chennai one.
Right.
And the channel checks suggest that is also getting a very good response. I think other than execution, I hardly find major risk for this company, because it's a pretty stable set of annuity income which they get from lease rentals.
Yeah.
A general slowdown in the retail sector can at the most hamper the growth or something.
You won't be concerned about the management quality? Because that usually is a sticking point when it comes to realty.
It is, but since the nature of income is annuity based, it's a pretty, as I mentioned, that about 90% of the income is from lease rentals, management quality takes a little backseat for me in that sense.
Okay, all right, fair enough. There you have it, guys. Well, largely positive views coming in as far as Phoenix Mills is concerned as well. And on the other hand, we also have skepticism towards the entire sector. So that's the view coming in on Phoenix Mills. But with that, we've run out of time on the show. So I'm going to thank all our experts for joining us and giving us their views and joining us this discussion. But we're also going to wrap this edition of Hot Money. Don't go anywhere. Ask BQ is up next. So stay tuned on Bloomberg Quint.